Welcome to Bendigo Bank's market update for March, with a summary of the latest data, events and forecasts for the domestic economy and global markets. This month we'll have a quick look at the immediate impact of the Middle East conflict, recent developments in labour markets, and what this will all mean for the RBA and official interest rates. The US and Israeli strikes and the Iranian retaliation have added another dimension to the recent volatility in financial markets, already elevated from US tariffs being revamped after the Supreme Court ruled last year's tariffs illegal, and also volatility in US stock markets as various AI scenarios were hotly debated. The global macro and market implications of the attacks on Iran depend primarily on how long the conflict lasts for and, crucially, on how long the Strait of Hormuz remains closed, being a vital artery for global energy flows. The price of oil was already rising ahead of this weekend's military strikes, but has risen a further 20% this week, with fears that a prolonged conflict could see further upside risks to energy prices, including LNG. This all has a range of potential implications. Not all to the downside, given Australia is a net energy exporter. However, the prospect of higher oil prices and a range of commodities does add to inflationary risks, depending on the breadth and length of the conflict. As a rule of thumb, a 5% permanent increase in oil adds around 0.1% to CPI. But it also does dampen sentiment and demand, so stagflation risks have re-emerged. The January monthly CPI was still uncomfortably high at 3.8%, with the core trim mean at 3.4%. So further inflationary pressures come at a difficult time. And while we currently only expect one more hike this year, the latest jobs data makes May the most likely timing for the next RBA hike, and also confirms that we're likely heading into a drawn-out tightening cycle into 2027. Unemployment fell to 4.1% in trend terms in January, and recent RBA comments on labour markets have noted that conditions are stronger than expected, adding to capacity pressures. But as the chart shows, Australia not only has a lower unemployment rate than our peers, but is the only country in the group with lower unemployment today than at the start of the decade. A healthy sign for strong demand, but an improvement in productivity will be needed to avoid this translating to further cost of living pressures. The next two jobs reports, out on March 19 and April 16th, will therefore be important for the May RBA decision, assuming they remain on hold in March. But despite the prospect of slightly higher rates here and potentially in other advanced economies, and despite fresh trade uncertainty via tariffs and the latest military conflicts, stock markets have so far only retreated a few percent from their recent record highs. How resilient markets will be over the coming weeks will again be dependent on the extent and length of the Middle East conflict and associated disruptions to global trade and energy. And similarly, FX and bond markets will likely be tested by these events. Global growth was forecast to be around 3.33% this year, but a lasting conflict could see downgrades to this view. For the moment, the Aussie dollar is on the defensive, although holding above 69.5 US cents, despite safe haven buying of the US dollar, and global bond markets are under pressure. For Australia, it remains a good time to be AAA credit rated. And that's the market update from Bendigo Bank.